Why is New York pricing its spot on something in London? Like, that's legacy. It's their grandfathers were there 300 years ago. Wonderful. That's probably time for some modernization, right? Having some spot market here in America that reference the American spot price and tied to the derivatives market that we all use just seems like a sensible innovation that is long overdue.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Wade Brennan, CEO and co-founder at Kilo Capital. Kilo Capital would like to emphasize that Wade's appearance on today's episode and his comments are not meant as a solicitation to do business with Kilo Capital or as a recommendation on any transaction. We'll be discussing with Wade the effects of the recent tariff-related price volatility and pricing dislocations on the users of gold, and the role of bullion banking in the gold market of the 21st century. Hello, Wade. Welcome to Smarter Markets.
Thanks for having me, Dave.
Well, thanks for being here today. You know, in the first two episodes of this series, we talked about the use of gold as an asset, as collateral, as money by banks and central banks in the West and by individuals in Asia. And I wanted to talk with you about the role of gold in the 21st century because at your company, Kilo Capital, you work with companies that use gold as part of their business. And you use the tools of bullion banking to connect these users of gold to the wider market of banks, central banks, and investors. So I thought we could start there with a term that not everyone may be familiar with. And so I wanted to ask you, what is bullion banking and what role does it play in the gold market of the 21st century?
Sure. So bullion banking is really about facilitating the activities of the real world companies that manufacture or wholesale or process gold and products that contain gold. And really, these companies borrow the gold instead of buying the gold. And that allows them really to solve two big problems that they have. The first is they need to finance that asset. In some cases, it's the biggest asset they have in the whole company. And the other big thing that it does is it helps them be agnostic about really what happens to the price of gold. If you think about a jewelry manufacturer, the jewelry manufacturer, let's say, they needed 1,000 ounces of gold to make some rings. And they intend to sell these rings to Walmart when they're finished. And if that jeweler just went out and bought the 1,000 ounces of gold and then went about the business of turning that into rings, then when the day came to sell it to Walmart and Walmart said, great, what's the price of gold? And I'll buy those rings at the price of gold plus the per widget markup that we talked about, that jeweler is going to make or lose a lot of money, and it will have nothing to do with making of jewelry. And so by borrowing the metal at the beginning of that process and only buying it at the end when they're pricing that jewelry to sell to Walmart, that way that jeweler is really just in the business of fabricating the widgets, selling them on, and making the spread that they intended to make. And really, bullion banking allows companies in the real world economy to operate even though they're processing and manufacturing things out of an asset that can be very volatile in its price.
And I imagine that volatility can be large relative to the margin or the spread they're earning on transforming gold into jewelry.
Absolutely right. Yeah, it can be many multiples of that spread, particularly, in the current environment when things have gotten a little bit more heated. So absolutely right. It's the only way to safely manufacture these kind of products that have very thin margins is to do so well. addressing that price exposure. And bullion banking provides those tools.
And when you say that they borrow the gold, who are they borrowing the gold from?
Well, there's a few players around the industry. There's a few banks that are still very much involved in the industry, and then players like Kelo. Companies like Kelo make gold leases and do things like repo for companies that need it. So they borrow the gold physically from banks and trading houses like Kelo.
And bullion banking has been around for centuries, if not millennia. So I was curious, how has the nature of bullion banking evolved over the course of your career?
Sure. I mean, over the course of my career, we've seen some pretty significant changes in the regulatory landscape. When I joined this sector of the market, it was really controlled by banks. And what we've seen post Basel III is that some of that business is less suited to being done at banks, right? The banks are still wonderful at dealing with large investment grade corporates that need to borrow gold, but also to do other stuff, interest rate hedges and bank accounts in Mexico and all these other wonderful things. But that sort of mid-market manufacturer or wholesaler is maybe not necessarily as good a fit for the investment banking division where the bullion banking activities reside at a large bank. And so you now have this split happen in the market where a lot of it is covered by the banks, and some of the Japanese trading houses play a good role there as well. And then you have, some non-bank lenders like Kelo that fill in those gaps.
And, you mentioned jewelry as one of the physical uses of gold by companies today. What are some of the other bigger uses?
Yeah, absolutely. I mean, gold is in places you would expect it to be, right? Jewelry is the obvious one. Bullion and coins is another big one, and certainly been a really, really hot sector from sort of the beginning of COVID until kind of about the midterm elections when things really kind of tailored off. Other things that might not be so obvious to most people, your iPhone, the computers that we're talking to each other on right now, all have gold. And then behind all of that, there's a really complex and interesting supply chain, value chain that takes place all the way through from, when the stuff comes out of the mine and gets shipped into a refiner, through a series of intermediate fabricators before it ever becomes your phone or a piece of jewelry or that bullion coin you buy off a website. And then the stuff is infinitely recyclable. And so there's a whole segment of the market that is all there to support the collection and recycling of this stuff because it has high value and it's just infinitely recyclable. And, I'll just extend that a little bit and say, as we look at some of the other precious metals, silver, the platinum group metals, and even copper now, the same dynamic is true and even more so true that these companies need the ability to borrow this stuff and eliminate their price risk. And it's just in so many things that the people never thought of. You can't drive your car or turn on the light without there being some silver involved, certainly some copper. So these metals are everywhere in daily life and maybe not obvious at first glance.
And you mentioned like all throughout the supply chain, the value chain, you've got people with different exposures to the price risk. You got producers, consumers, you've got all the folks in the middle earning their money on narrow spreads on a potentially volatile commodity price. What sort of tools are available? What sort of tools do they use and need to finance their gold use and manage that price risk in the gold market?
Yeah, probably one of the most common tools is the gold lease. And the gold lease, I mean, look, if you think about private mint that's making, 1 ounce bars and rounds to sell to retail investors, or an electronic scrap aggregation and recycling companies, they couldn't be more different. But with a few tailored adjustments in each case, a gold lease is a pretty versatile tool and actually really satisfies the need that both of these companies would have to really eliminate as much as possible that price risk exposure and also finance that really valuable asset that can, like I say, in many cases, it's the biggest piece of their balance sheet. So the gold lease is really one of the biggest tools that we see and that we use with our customers. There's another tool which is also very common Most people would refer to it as a repo, and it's really good for financing finished goods or raw material inventory. And so companies that are manufacturing, wholesaling product that has identifiable widgets, whether those are coins or bars, pieces of jewelry, anything else, it's a really great tool for companies to really leverage up their balance sheet, to be able to have a ton more inventory under their control relative to the size of their business. And so we see a lot of use of that. Coin and bullion sector would sort of be a big user of that tool as well. But those are two of the really big tools that companies use.
And could you walk us through how like a typical repo transaction works in the gold market? People are probably more familiar with them from the bond markets.
Sure, not terribly dissimilar. Really, you're still talking about the company has some inventory. They don't have a buyer for that inventory today, but they know that they will at some point in the future. And they simply sell it into a repo provider like Kilo or one of the great bullion banks that are out there. That bank will hold that. And in the future, when the company gets an order for that product, they just call up and buy it back at whatever the current market price is at that time, right? And so they've got the control, the ability to go grab that inventory at the ready. They know it's available to them, just like if they owned it, but they don't. It sits on the bank's balance sheet or on our balance sheet, and just allows that company to control a lot more inventory. And it really is that. It's a transaction to sell the product into us at the beginning. And when they need it, whether that's all at one time or in dribs and drabs, that company just calls back the repo provider, makes the purchase transaction, pays for it, and moves on with their day.
And I think most of us are familiar with, the big gold markets, the futures market in New York and the spot market in London. How do firms like yours engage with those markets in order to serve your customers?
Sure. So much like our customers, bullion banks, Kilo, the others, we're generally not in the business of taking price risk either, right? And so on the back end, we're using those markets to hedge out our exposure. And so while we own a whole lot of metal that is lent out to, real businesses out there in the real economy, we have need to hedge that exposure as well. And so we use the markets in London and certainly the COMEX. We use those markets extensively to hedge our exposure to determine price, right? We talk about, each of these repo or lease transactions involves a buy and a sell between the bullion bank and the end customer. What's the price of that? And so, often that's either the London price or the COMEX price, or in the last several months, some other price that's the best guess as to where the market is because of the dislocation between the two. Bullion banks are extensive users of those markets for hedging.
Yeah, and I wanted to ask you about that, the recent dislocations, which have certainly grabbed attention. How do they affect what you do and the companies you're supporting?
Yeah, the dislocation has been significant. And I know that we've had some guests on here who've done a wonderful job of kind of explaining what's happening out there. The dislocation really has resulted in a discrepancy between the London price, which, most of the world looks at as the spot price for metal, and the price of the nearest futures contract that's active. And there's always a bit of a disparity there. Most of that typically has to do with, the time value between the future date and the spot date. But a couple of times in recent history, we've seen a dislocation that's really abnormal. And it happened back during the early part of COVID. And now we've experienced that again during this period of uncertainty around the tariffs. And so what has that really done and how has it impacted the market? Well, the physical premiums that companies need to pay for their raw materials has been extremely volatile, and more importantly, has been significantly higher than would be typical. And to put that into context, we've seen gold EFPs from $60, all the way down to $23. And I'm not talking about over the last several months. I'm talking from 4:30 p.m. yesterday afternoon to 9:30 p.m. last night. And so imagine trying to determine at what price a physical metal provider should sell metal to an industrial company that needs it. Very, very challenging. And so The market is impacted by the higher price, the higher premium for the metal. And the other thing that's happened is we've seen a significant increase in the metal lease rates. That's really the funding cost, the OPEX funding cost that these businesses need to face. And again, when you talk about some of these businesses in the gold sector, their inventory is really one of the biggest assets they have. And so when that funding cost increases materially, that is very, very stressful on their net margins. I was talking to a person yesterday who's in the business of operating a fabricator of very industrial gold product. And, she was describing how she is completely struggling to pass on these increased costs. If it were just a matter of the gold price going up, that would be no problem. That's contractual. She can pass that on to her customer base. But because we're talking about premiums over the price, which aren't visible to the market, and we're talking about a core funding cost in her business, she doesn't have a mechanism to pass that cost on. And so, some of these companies are just facing, really compressed margins, sometimes, even a bit tighter supply or less availability of the specific raw materials they need if they're making something very technical and require a very high grade of gold. So, lots of challenges out there that these companies are facing as a result of this dislocation.
Oh, that's fascinating. So I hadn't thought of, you could probably say, well, the price that everyone sees on the COMEX or the London market is pretty visible. And if that goes up, people expect that the price they pay for physical goes up. But if you have to say, oh, I need to charge you an extra $40 over that for physical today versus 2 days ago, that's probably an interesting conversation.
It's one I've unfortunately had to have. And I know my counterparts and our other providers have had that conversation repeatedly over the last few months. And it's great to see that, the media is starting to cover the storyline a little bit. And so, at least there's a little bit more transparency out there for these companies to be able to point at why it is that they're facing some of these increased costs.
And you had mentioned the rise in lease rates recently. Whenever I hear gold lease rate, I immediately think about central banks. And I know there was some things in the news about Bank of England not necessarily making gold available to the market and that being part of the rise in lease rates. How does that dynamic work? And what do you make of that story?
Yeah, absolutely. I mean, central banks are big holders of gold. They hold it in deep storage. They lend it to some of the large bank groups that are involved in bullion banking. It is an important source of the funding that gets used in our industry. It is not the only source, though. And I think that issue gets a lot of coverage, and rightly so. But a lot of the industry is actually using money, right? Just regular old US dollars, buying the metal and hedging it, whether that's in London or New York or with other forward spreads with customers. And so, yes, absolutely significant funding source to the industry. But unlike the old days of Moses Makata, the gold deposit is not the only source of funding for the industry. And as a result of that, the nature of the hedging market really also very much informs what that lease rate is. And so, as that London situation where the Bank of England's been a little backed up in getting the stuff out the door, that has caused a tightening in lease rates and an increase, largely because it's affected that forward market, which in turn drives that lease market.
Anything nefarious on the Bank of England's end, or is it more, it just takes some time to get things out to the market?
I expect it's really that. I mean, this stuff we're talking significant volumes. You can see it in the trade flows that it's so big. The amount of gold and silver that have come into America since this dislocation popped up. I don't think we're talking about the old gating the LME warehouse so you can keep charging storage fees kind of issue. I expect that's not what we're talking about here. This is probably a physical reality of you don't want to rush when you're dealing with an asset of this value. And you want to be careful. And I expect there's nothing fishy that I'm aware of anyways.
And I wanted to ask you about some of these really massive gold flows that we've seen recently, right? I got a lot of people were pointing to the flows out of Switzerland into the United States. Can you just walk people through what was actually happening there? and what's happening now?
Sure. So the biggest gold refineries that are good delivery refiners are based in Switzerland. And so, all this gold that comes out of London, some of the other guests you've had on recently have really touched on this issue in a really concise way. But the deliverable form of gold in New York and the deliverable form of gold in London are two different things, right? You have a large bar in London and a 100-ounce bar in here in New York. And it's the same stuff, but it's not in the same form. And so to move it from London is not really putting it on a plane at Heathrow and flying it over to JFK. First, it's got to take a little side trip, usually through Switzerland, to get converted into the deliverable form of bars for the COMEX. And I think that's why we see it coming in through Switzerland. But is that gold also ultimately coming out of London? Is it coming out of Dubai and Asia and other places? Yeah, but it needs to be in the right form and from the right good delivery refiner to be able to be placed into the COMEX and capture that disparity, that EFP between London and US.
And I wanted to ask you some of the things you mentioned. They point to some of the inefficiencies in today's gold market. And I'm curious from your vantage point and from your seat, what do you see as some of the biggest problems or inefficiencies in today's gold market?
It strikes me as odd. And I think your guest, Sunil Kashyap, I think it was last week, he pointed out that with the spot price of metal being determined mostly by what the local London price is globally, that can cause some real friction. And he was describing, hey, we've got the situation where you got dealers trying to buy at the London price and sell at the New York price because, you can point at both of them and they're very widespread. And he pointed this situation out as happening in his market. And, I would say here it's very similar, right? I would say one of the bigger challenges is the whole world is using the same spot price, which doesn't tie to the futures market that most of the world uses or the local delivery markets. And so the fact that we have that two-track system with two different deliverable forms in different locations, well, historically it wasn't a problem until COVID hit. It's become a much more acute issue over the last few years.
And, when you look at, I feel like in many markets, right, things aren't a problem until they are a problem. And, I know for a long time, can correct me if I'm wrong, but the London gold market was seen as a little bit of a small club. How big an issue is that? Is it difficult to get access to those markets?
It's a great question. They're very accessible, and the issue is really how you access them, right? They're not accessible directly. Most institutional investors can't even access directly the local London market. It is a very closed club. And in fairness to the members of that club, the compliance costs when you're dealing in precious metals are extremely high. And the cost of making an error there is unacceptable, right? So it's sensible that they need to weigh the costs of the strict diligence that they need to do very carefully against, frankly, what's in it for them, right? So how do people access it? Well, it's just several tiers of dealers that intermediate between that small club and the real world, right? That small club gets the benefit of aggregating all of this trade, but the real activity might be two or three layers deeper in, right? We're quoting local London prices to our customers every day. Those prices are conditioned, right? With a layer or two of additional spreads. It's an inefficient system for the global market to price on, right? If anybody goes on to an exchange and wants to transact, they're getting the same price as anybody else on that exchange. It's clear and clean. And over the counter market in London and the way it's evolved is maybe a little bit less transparent, a little bit less even for market participants to be able to access.
Well, and I want to bring the conversation back to the United States because there's been an issue lurking in the background, which we got to talk about, tariffs. And I'm glad you could make time to record today for our listeners. We're recording the day after Liberation Day when President Trump's wide-ranging tariffs were announced. Notably, gold is excluded from the tariff so far. We've seen a broad stock market sell-off. And I was curious, boots on the ground, how's this affecting the gold market today?
Very few times have I ever seen an entire industry take a deep breath and exhale in absolute relief that, that this is how it panned out. And so, look, today we have seen the metal prices sell off to sell everything day. And as you say, the stock markets are selling off globally. We've seen, silver down a couple of bucks and gold down about $30 on the day. The much bigger story is that disparity between the London and New York prices for these metals has collapsed to a much more normalized level. And, for example, as we were watching the speech, the Liberation Day announcement take place, that disparity in silver was dollar five per ounce, as that was going on in gold. We were looking at $60, at 4:30 in the afternoon while that announcement was taking place. And then the market closes at 5 for an hour and everybody waited. And it became apparent that gold and bullion generally was excluded. And within just a few hours, we saw that normalization begin. And here we are in silver, it's about a 10-cent EFP right now. And gold looking around $22, somewhere in that zip code. And so just a significant return to a much more normal state. Because if those metals are excluded from the tariffs, as we now understand they are, that means they can freely flow as they have recently. And those arbitrage opportunities can be closed.
And I'm curious because so much, as we've discussed, of that spread between New York and London, the flow of gold from London through the Swiss refiners into the US was driven in anticipation of potential tariffs. Now that it's been announced and they've been excluded, what does that unwind look like? Are we going to see a lot of gold from the US flow back to Switzerland and get converted into 400-ounce bars and head back to London?
It's a great question. I wish I knew. I think, it'll be interesting to see, given the scale of what's happened, if we actually see, something like that disparity go the other way, because there's so much metal here in America. It's a great question. If I knew the answer to that, I'd share it, but I'm stumped.
And I wanted to ask you, because there was another point that came up when we were talking with Sunil Kashyap last week. And that was when kind of talking about the attitude towards gold among private investors in Asia versus the West. And he raised the point that in many Asian countries and also developing economy countries, people are used to policy being unstable and their government being unstable. And so gold is seen as a stable asset, much more so than government debt. And in the West, we've had a very different experience of people think of a T-bill as the risk-free asset in the United States. And I'm curious, when you look at, it's very early innings, obviously, but do you see that conversation starting to change at all in the United States and among your customers? Or are you seeing more investors giving gold a look as a stable store of value?
I think the conversation has evolved here in America. The more recent uncertainty is definitely underscoring this issue and maybe making North Americans think about this in a way that we've been fortunate not to have to think about for a long time. We haven't had a good credit crisis in the West in a really long time. I don't think most people remember what it's like to take a bath on a bond. So, there's a lot going on there. I do think that situation is evolving, and I'm not necessarily a crypto enthusiast. I think what's been productive about that movement is the discussion of what is fiat currency, what is the reliability of some of these instruments, and something that the people in more developing nations have known for a very long time. It does seem like there's a growing awareness of gold as true money, really growing, here in America.
Well, you brought up crypto, so now I have to ask, because there's been a lot of conversation over the years of some crypto enthusiasts will say it's a replacement for gold. It sounds like you're more of they're potentially more on the same side. What is your experience with the impact of crypto on the gold market?
I would say at the margins, maybe it has pulled a little demand away from, say, coin and bullion dealers. Not that they've struggled to sell product certainly during that 2020 to 2023 and a half kind of period. But, I think just raising the awareness of what a fiat currency is maybe very productive.
And this series is gold in the 21st century. So I'm asking each of their guests for their perspective. And so when you think about the role of gold and of bullion banking in the 21st century, what do you think that role should be?
I think from the standpoint of bullion banking, we're talking about a service, an industry, a function that's been around for centuries. I don't really see that changing. Companies are not all of a sudden going to, want to speculate on the price of these metals, and they're not going to want to stop. Maybe people are not going to stop buying jewelry. We've been making that for centuries. And so, I think there's going to be largely an ongoing demand for services that bullion banks provide and the needs that these customers have. The role of gold more generally, interesting. I think if there's an evolution, it's maybe an awareness, but also in the tools that are available to investors to access it, right? Sunil was on last week and he talked about the service at FinMet where people in Asia can go on there and buy gold in very small increments with a very narrow spread. And that's a nice, efficient way for that community to be able to buy. And we have similar services here in the West. And on top of that, there's ETFs, people, whether they're a Robinhood or a Charles Schwab, can click in their account and access that product at very efficient spreads. And then any form of precious metal you'd like to order from a bullion dealer is just so readily available to you. So I think there's a ton of access. There's an evolution like many industries as technology continues to take hold. Fractionalized gold in pools is growing. And, I know some people are trying to get some traction with tokenized gold. I'm not sure how much traction's really been realized to date, but I think that technology is really mostly driving increased access and options for those investors.
And because this is Smarter Markets, before I let you go to get back to the market itself, I just wanted to ask you, when you think about what you would like the role of gold to be in the 21st century, what improvements do you think we need to make to our gold markets, whether it's in market infrastructure or new technologies, to allow them to take on that greater role in the 21st century?
I think the biggest thing is we need a hedging market which is tied to the underlying local market price. And, again, I go back to what Sunil said, where, they don't know what the price of gold is in Asia when there's a disparity between London and New York. And why is New York pricing its spot on something in London? That's legacy. It's their grandfathers were there 300 years ago. Wonderful. That's probably time for some modernization, right? Having some spot market here in America that reference the American spot price and tied to the derivatives market that we all use just seems like a sensible innovation that is long overdue.
Thanks again to Wade Brennan, CEO and co-founder at Kilo Capital. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter Markets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.